Welcome to This Explainer. I've been looking into the math behind the financial rules we all grew up with, and honestly, the numbers reveal a completely different reality. We're constantly surrounded by financial noise, right? Rules of thumb that just haven't aged well, seductive narratives about picking the next big stock, and a culture that literally pushes us to buy way more than we can actually afford. Well, today we're cutting through all of that noise. We're going to look strictly at the numbers to build a playbook of mathematical reality together. So if you're ready to see how wealth is actually built and protected, you are in the exact right place. Let's get into it. Okay, so here's our roadmap for today. We're going to start with the broken rules of money, climb the optimal financial ladder, compare income versus true equity, uncover the stock-picking illusion, navigate invisible traps and manias, and finish up with the ultimate wealth variable. It's a progression. Every step builds on the last, taking us from the micro level of your personal budget all the way up to macroeconomic forces. All right, Section 1, the broken rules of money. Specifically, why the 28% rule leaves you drowning. Let's take a look. So we've all heard that golden rule of real estate, right? Spend no more than 28% of your gross income on housing. It sounds super clean, it sounds responsible, but in today's economic environment, following this outdated rule is a total trap. Look at the theoretical math on the left. Someone earning 80 grand a year, calculating 28% of their gross income, gets a cozy budget of about $1,867 a month. But here's the brutal reality. Owning a $280,000 home today at a 7% interest rate, well, once you include property taxes, insurance, PMI, and a conservative maintenance buffer, your actual monthly cost is pushed to over $2,700. When you compare that to your actual net take-home pay after taxes, you are absolutely not spending 28%. You're spending 54% of your spendable income on housing. This is exactly why so many people are quietly drowning while looking incredibly successful on paper. To put that into perspective, let's map this out. Assuming a safer maximum of 35% of your net pay going to total housing costs, an $80,000 median salary gets you a home far, far below the national average. To comfortably afford today's median home price, which is roughly $420,000, without stretching yourself into financial fragility, you realistically need a household income of around $130,000 to $150,000. Now sure, lenders will approve you for much more based on your gross income, but the actual math tells a wildly different story. Moving on to Section 2, the optimal financial ladder, the exact sequence of wealth. Because once you understand how to budget, you really need to know exactly where to deploy your money. Where and when you invest matters so much more than picking the perfect asset. There is a rigorous sequence of operations for building wealth. Step 1 is a starter emergency fund, just $1,000 to prevent you from liquidating investments when your car inevitably breaks down. But Step 2 is where the magic happens. The employer match. If your company offers a 401k match, capturing it gives you an instantaneous, guaranteed 100% return on your money before the market even opens. Honestly, skipping Step 2 is literally leaving free money on the table. And only after that do we tackle Step 3, which is stopping the 20% bleed of high-interest credit card debt. Sequence is absolutely everything here. Now, an absolutely crucial point is choosing the right vehicle at Steps 4 and 5. Let's look at Maya and James. Maya uses a traditional 401k. It grows tax-deferred, yeah, but there's a huge tax illusion going on. That big number isn't all hers. She's going to owe taxes on every single dollar she withdraws, and the government actually forces her to take required minimum distributions at age 73, whether she wants the money then or not. James, on the other hand, uses a Roth IRA. He pays taxes today, but his growth is 100% tax-free with zero forced withdrawals. If historical fiscal pressures cause tax rates to rise over the next 30 years, James's Roth wins mathematically. He has basically earned complete immunity from future tax rate uncertainty. Game changer. All right, Section 3, income versus true equity, the river and the reservoir. This perfectly explains why high earners often go broke, while modest earners become completely free. The math of financial freedom really comes down to the rule of 25. It's simple. You take your annual living expenses and multiply them by 25. That number is the exact equity you need to generate a safe 4% withdrawal rate. Meaning, you can pull that much out every single year without draining the principal. It covers you forever. Think about it. A $200,000 a year earner who spends every dime they make has zero runway. If they stop working, they have nothing. But an $80,000 earner with $1 million in equity is mathematically far wealthier. They could literally stop working tomorrow. And this brings us to a really fascinating concept, the river versus the reservoir. The river is your income, your labor. It keeps you alive today, sure, but it only grows slightly above inflation, and it stops the exact moment you stop working. The reservoir, though, is equity and ownership. Historically, it grows around 7% above inflation. Over 40 years, a dollar of labor becomes about $120. But a dollar of equity? That becomes roughly $1,500. Converting the river into the reservoir is the absolute only path to true financial freedom. Next up, Section 4, the stock picking illusion, why 96% of stocks fail you. If we're going to build that equity reservoir, we have to address a very seductive myth. And that myth is the idea that picking individual stocks is the smartest way to invest. The statistical improbability of stock picking is staggering, honestly. Historical data reveals that 96% of all stocks perform roughly the same as boring, safe treasury bills. All the immense generational wealth created by the stock market over the last century was driven by just 4% of the companies. Just 4%. Finding those specific companies before they're obvious is nearly impossible. This is exactly why owning the whole haystack via an index fund mathematically beats looking for the needle. Just consider Warren Buffett's famous $1 million bet back in 2008. He bet that a simple, boring S&P 500 index fund would beat a hand-picked portfolio managed by elite hedge funds over a decade. And the results? Completely mind-blowing. The index fund returned nearly 126%, just totally crushing the highly paid experts who managed only 36.3%. When you strip away the high fees and the human error of trying to time the market, the passive strategy just simply wins. But I know what you might be wondering. What if the market feels too expensive? What if it's at an all-time high? Waiting patiently in cash for a 10% dip feels disciplined, right? Actually, scratch that. It's a mathematically losing form of market timing. Because all-time highs cluster together during bull markets, the person waiting on the sidelines misses out on compounding and dividends. The data clearly shows that investing consistently, even at all-time highs, historically outperforms waiting. In fact, missing just the 10 best days in the market over a 20-year period cuts your total returns by more than half. No way around it. Which brings us to Section 5, Invisible Traps and Manias, Bonds, Bubbles, and Crowd Psychology. Let's zoom out to the macro level to see the cyclical madness that wipes out the uninformed. To understand global finance, you really must understand the bond market. It's this $130 trillion invisible engine running everything. When interest rates rise, bond prices fall. It's just a mechanical relationship. But yields don't just reflect interest rates, they reflect trust. When investors lose faith in a borrower's ability to pay, they demand a higher yield, which drives the bond price down. And when short-term yields become higher than long-term yields, which you've probably heard called an inverted yield curve, it's a massive red flag. It means investors are terrified of the near future. An inverted yield curve has predicted every single U.S. recession since 1955. Now check out this number, 35,000 billion. It's almost too large to even comprehend. $35 trillion. That is the current U.S. national debt. For over a decade, this was financed at near zero interest rates. But as rates have risen recently, the math has fundamentally changed. Refinancing this absolute mountain of debt at roughly 5% means that interest payments alone are ballooning toward $1 trillion a year. That actually exceeds the defense budget. It's a mathematical strain that puts massive structural pressure on the entire global financial system. And that structural pressure often collides with human psychology, creating market manias. Whether it was 1929, 1999, or 2006, the assets changed, but the fundamental mistake was exactly identical. It's what John Maynard Keynes called the beauty contest problem. People stop asking what an asset is actually worth, and they only ask what someone else will pay for it tomorrow. Price becomes completely divorced from underlying value. When the person shining your shoes or driving your cab is giving you hot investment tips, you're looking at a crowd, not evidence. In the crash, it's inevitable. Finally, Section 6, the ultimate wealth variable: time, survival, and avoiding zero. To survive these manias, we need to understand that survival itself is the entire strategy. Compounding is completely counterintuitive to the human brain. We naturally expect it to look like a staircase, but it is actually a ski jump. If you save $500 a month at an 8% return, after 10 years, you have a modest $91,000. It feels really slow, but when you reach year 30 to 40, wow. In that final decade alone, without saving a single extra dollar per month, the balance absolutely explodes, adding over $1 million. Time does all the heavy lifting at the very end. The system heavily punishes those who quit early or get distracted. Understanding how time multiplies your money is kind of magical, and we can calculate it instantly using the rule of 72. Just divide 72 by your expected return rate, and you get the number of years it takes for your money to double. At an 8% return, your money doubles every 9 years. This is exactly why patience pays off. A slightly worse return held for a very long time easily beats a high return that you sell out of quickly. Time is the ultimate lever. But what happens when you try to speed up time using leverage or borrowed money? Well, leverage is a two-way amplifier. A 10% rise in your home's value gives you a 100% return on your 10% down payment. You look like a genius, right? But a mere 10% drop entirely wipes out your 100% equity, pushing you underwater. In the stock market, leverage can trigger a catastrophic margin call exactly at the bottom, forcing you to lock in a permanent loss precisely when patience would have saved you. Because losses and gains are not symmetrical. If you lose 10%, you need an 11% gain to get back to even. If you lose 50%, you need a 100% return just to return to where you started. Compounding has one fatal enemy, and it is the number 0. A single 100% loss destroys all future math. That is why managing risk and sizing your bets carefully so you never face total ruin matters far more than the quality of the bet itself. One catastrophic loss ends the game forever. So we've covered a lot of ground today, right? From the real cost of a mortgage to the absolute laws of compounding. I want to leave you with one provocative thought to anchor this mathematical playbook we just built together. When you look at the assets people are most excited about today, the narratives you hear repeated without examination, are you looking at actual evidence, or are you just looking at a crowd? Keep the math on your side. Thanks for joining me on this explainer, and keep learning.